Hi there. VAT on food isn't always straightforward. Let's explain how eat-in and takeaway sales are treated under UK VAT rules.
Imagine for a second that the exact wording on your menu board, or even just the type of paper bag you're handing to your customers, is secretly eating away 20% of your daily revenue. Sounds crazy, right? Well, welcome to this explainer. Today, we're going to completely untangle the complex UK tax laws on food. This explainer is brought to you by Atlas Tax Advisors, or ATA. They're a premier UK accounting firm advising businesses just like yours on tax planning and compliance. As a tax expert, I'm absolutely thrilled to guide you through this fascinating and honestly highly consequential topic. Just picture this. You open a letter from HMRC and you're staring at a £17 million tax bill. Why? Simply because your rotisserie chickens were sold in the wrong type of paper bag. No, really. This is exactly what happened to the supermarket giant Morrison's. I know, it might sound totally absurd, but it proves exactly why mastering VAT compliance is just so critical for your business. Whether you're selling a toasted panini or a warm pastry, the line between 0% and 20% VAT is literally razor thin. Okay, let's take a quick look at our roadmap for the next 10 minutes. We'll be covering the high-stakes VAT trap, eat-in versus takeaway rules, the hot versus cold statutory tests, that infamous Morrison's chicken case, some common misunderstandings, and finally, a summary and some professional advice. Right, let's dive straight into Section 1, the high-stakes VAT trap, and exactly why getting your food temperature wrong can cost millions. Now, while these rules absolutely affect all sorts of businesses, from startups to massive contractors, our focus today is very specifically on you, the UK small business owner or director operating a cafe, a bakery, or a takeaway. The team at Atlas Tax Advisors knows firsthand that making quick, daily operational choices on the shop floor about something as simple as food temperature can trigger a massive 20% VAT trap. And as we all know, ignorance of the law is never an accepted defense during an HMRC tax inspection. Moving on to Section 2, eat-in versus takeaway. Let's look at how where your customers sit actually dictates your tax. So we have to start with the baseline physical boundaries. Before we even start talking about how hot the food is, we first have to look at where your customer is actually sitting down to eat. Here's the golden rule. Any food or drink consumed on your premises, whether that's at a nice indoor table, an outdoor bench, or even a shared shopping center seating area, is always standard rated at 20%. Takeaway food, on the other hand, well, that requires a much closer look, because it could be 0% or it could be 20%. It's a bit of a minefield. To understand why, we have to look at the legal definition of a course of catering from the Value-Added Tax Act. Basically, this means that if your takeaway food is hot, it crosses over the line into being a catering service, and boom, that instantly attracts the 20% standard rate. In the eyes of HMRC, you aren't just selling groceries anymore, you are actually providing a hot meal. Which brings us to Section 3, the hot versus cold rules, and the 5 statutory tests you need to know. So, to figure out exactly what HMRC considers hot, we have to rely on Note 3B of the Value-Added Tax Act. You might remember this being introduced after that whole messy 2012 pasty tax fiasco. Anyway, the baseline precondition here is that the food must physically be warmer than the ambient room temperature at the exact moment it's handed over to the customer. So if a freshly baked loaf of bread has cooled down completely, it's not hot food. But if it's still radiating heat, well, then we have to run it through 5 objective tests. And here is where it gets absolutely critical, so pay attention to this part. If your warm food fails even a single one of these 5 objective tests, your 0-rated takeaway instantly becomes a 20% standard rated supply. So ask yourself, was it cooked specifically to be eaten hot, like a burger? Was it heated to order, like a toasted panini? Is it being kept warm under a heat lamp? Is it sitting in heat-retentive packaging? Or is it marketed on your menu as hot? If you answer yes to just one of those, you owe 20% VAT. No way around it. Now let's look at a real-world disaster in Section 4, the Morrison's chicken case, and its £17 million legacy. To show you just how strictly HMRC applies these tests, we really need to examine this late 2025 tribunal decision involving Morrison's. Honestly, this case sent absolute shockwaves through the UK retail sector. Morrison's basically argued that their rotisserie chickens were just incidentally hot, meant to be eaten cold later on or reheated at home. And because they put them on unheated shelves, they figured they shouldn't be taxed. Makes sense, right? Well, HMRC and ultimately the courts saw it very, very differently. The tribunal got incredibly granular with the data here. They actually found that a tightly wrapped chicken in Morrison's specially designed bag cooled by 47% over a 2-hour period. Compare that to a 62% temperature drop for an unwrapped bird. To put that into perspective, it proved beyond a shadow of a doubt that the packaging was actively retaining heat. And just like that, they failed test number 4. And this brilliantly and painfully illustrates the danger of test 4 and test 5, because those foil-lined bags retained heat just to stop the juices from leaking in the boot of a customer's car, and because they carried a simple little "caution hot product" warning label, they failed the statutory tests. It literally turned the exact same chicken from a 0% VAT item to a 20% VAT item, all because of the bag it was placed in. Just think about that. Which leads us perfectly into Section 5, common misunderstandings and errors, and where exactly SMEs and startups tend to trip up. Look, if a giant corporation with top-tier lawyers can make a £17 million mistake over a paper bag, local cafés and bakeries can easily fall into the exact same trap. Did you know? Many companies encounter this exact issue when reviewing their tax position. They wrongly assume that just because a product leaves the shop, it's completely tax-free. But as we've just seen, the temperature and the intention behind it matter deeply to HMRC. Just looking at these tricky borderlines side by side really helps clear it up. Notice how adding just one hot ingredient to a cold bun, like slipping a hot sausage or a burger patty in there, instantly shifts your entire product into the 20% tax bracket. Or let's say a customer asks you to quickly toast their 0-rated cold sandwich. That simple act of heating it to order immediately makes it standard rated. It's really that sensitive. And get this, even the adjectives you use on your menu board matter immensely. Selling a warm pasty and labeling it freshly baked keeps it comfortably at 0% because the law actually allows for food that is just cooling down naturally from the oven. But if you take some chalk, cross out the words freshly baked and write hot pasties on your board, you've just failed test 5 and it's instantly going to cost you 20% of your margin. Another massive hurdle we see all the time is mixed supplies. Think of the classic lunchtime meal deal. If you sell a 0-rated cold sandwich alongside a standard-rated fizzy drink and a bag of crisps, all for one inclusive price, you have to be so careful. Failing to separate those items accurately on your till can lead to you severely over-reporting or under-reporting your VAT. Your point of sale system simply must be configured to split these out automatically behind the scenes. Okay, let's wrap things up with Section 6, Summary and Professional Advice, and how to protect your food business from HMRC. To make sure your business stays fully compliant as we move through the 2026-27 tax year, you really need to proactively review your seating arrangements, your food storage, your choice of packaging, and of course, your till systems. Honestly, leaving this to chance is a risk your margins simply cannot absorb. So here is a professional tip for you. Maintaining proper records is absolutely essential for HMRC compliance. If they ever conduct an inspection, you have to be able to prove why certain items were 0-rated. That means keeping crystal clear records of your POS data, your recipes, and even your takeaway packaging specifications. If you're a small business owner approaching that £90,000 VAT threshold, or if you just need some help restructuring your pricing strategy to account for these tricky rules, please contact the experts at Atlas Tax Advisors. They will help secure your margins and ensure total compliance. You can reach them at 074 04 427 275 or drop an email to info@atlastax.co.uk or visit their website at www.atlastax.co.uk. Oh, and please don't forget to subscribe to the ATA YouTube channel for a lot more essential tax insights just like this one. I do need to quickly mention that this explainer is provided for general informational purposes only, and it's not a substitute for formal, tailored, professional advice. Every single business is unique, right? So you should always consult a qualified professional at ATA regarding your specific circumstances. So I'll leave you with this one thought to take back to your shop floor today. Have you looked closely at your bags, your menus, and your heat lamps lately? Is your current choice of packaging or menu wording accidentally costing you 20% of your hard-earned revenue every single day? It is definitely time to check. Thank you so much for joining me for this explainer, and stay profitable out there.